Good morning. It's 9 a.m. here in Hong Kong, in Shanghai, and in Shenzhen. You're watching the China Show, our final full broadcast of the year. We're counting down to the open markets in Greater China. Let's get to your top stories today. Stocks across the region up after tech gains pushing Wall Street to yet another record. FX markets in focus with the yuan at its strongest level in over 14 months. 7 is very much in focus. And also in South Korea, warning against excessive weakness in their currency. Gold soaring above $4,500 an ounce for the very first time on escalating tensions in Venezuela, and also bets on more Fed rate cuts in 2026. Also ahead, Washington holding off on new tariffs on Chinese chips, even after accusing Beijing of unfair trade practices. Plus, we take a closer look at the challenges facing Chinese battery maker CATL as the company seeks new markets overseas. Welcome to the program. Hope you're all well. Lots to get through over the next 2 hours or so. Let's get started with what's really been a fairly consistent story almost all year round, with the exception of a few wobbles, as we can see. The rally across risk assets, right? Asia Pacific 227 right now on the benchmark, 0.3%. As you can see, the tech sub-gauge is leading that one. Kospi, there's a separate conversation. We'll get to that in a moment as far as the currency goes. Some strong language coming through out of authorities. They're leading to some strength coming through in their currency. Taiwan is coming online within that market. It's not just tech. We're looking at insurers too, given this rule change in FX. More on that as well later on. We talked about the yuan winning today. Dollar won down. As you can see, we're up 1%, stronger on 1% on the Korean currency, 1.4 rather. 156 now on dollar yen. The markets, they're warning of strong determination as it pertains to maybe these FX moves in the market might have reached maybe a tad or two, a level, a notch or two beyond what is comfortable, question mark. Right, the big story as well in markets is when you have copper, 12,000. We took that out yesterday, 4,500 in gold. Also a nice round number on platinum. We're up about 3% there. And silver, of course, 150% year to date. We took out 70 yesterday. It looks like 72 is very, very close, if not already on some contracts. Very quickly, the approach to the Chinese market open. So we talked about copper coming up on your screens as well. And the CNH dollars China is 701.7. And the reason that's important is that puts us about 0.26%, 0.27%. I'm just doing some rough math in my head, which roughly translates to that's about a 1 standard deviation move. Historical, that's daily. If we get that, which is rare, of course, statistically, that would take us below 7. Suffice to say, it's possible but unlikely. And we are looking at weakness going into the open today. And, of course, just a public service reminder that several markets in the region are operating on truncated sessions today: Hong Kong, Singapore, Australia, and also in New Zealand. Okay, let's have a look at the agenda today. And, okay. Is this the agenda today? Well, it's partly it. So the China-X rally, we had the fix. It's an early close in Hong Kong. But yeah, okay, we'll talk about this later. Okay, let's talk about the chip curbs, right? The U.S. is holding off on new Chinese chip tariffs until mid. We'll fix that for you is what I'm trying to say. That's despite accusing Beijing of engaging in unfair trade practices in the chip sector. Let's bring in Min Miller, our China correspondent, here with us on set to tell us more about this investigation. It's something that didn't happen overnight. It was months long. What are the findings and what it might mean for policy moving forward? Yeah,
so it's nearly a year in the making. It was launched in the final few weeks of the former U.S. President Joe Biden's administration, and it was expected that President Trump would resolve this. But the findings from the U.S. Trade Representative Office is that China has used aggressively and sweepingly used non-market policies to create foreign dependence on its products in a way that was not advantageous for U.S. commerce. So the decision is not to impose any tariffs in the next 16 months. But starting from June 2027, they will impose tariffs, but the rates are only going to be announced at least a month before. So this is a clear signal that President Trump is in some ways trying to stabilize ties here and keep to that trade truce that he agreed with President Xi when they met in South Korea. But at the same time, also creating that opening, right, to revisit this 1.5 years later and potentially a bargaining chip when China and U.S. has to renegotiate the extension of the trade truce.
Already, we're not even at 2026. You're taking us into mid-2027. Min Min, what was China's response to this?
So the Chinese embassy in the U.S. has responded and obviously hit back at this, saying that, they're opposed to this, and also saying that they will take whatever necessary measures to protect their legitimate rights and interests. And you can see here the statement they said, to instrumentalize and weaponize trade and tech issues and destabilize global industrial supply chains will benefit no one and will eventually backfire. Now, this comes as China also hit back against the new U.S. rules to ban foreign drones and drone parts, and also saying that the U.S. is bullying Chinese companies, saying that China reserves the right to protect or safeguard Chinese interests, and also calling on the U.S. to withdraw those rules.
All right, Min Min, thank you so much. Min Min Lo, our China correspondent there. Our other top story, all the data that came through overnight in the U.S., obviously the headline was GDP. Within that, you had several things like, so the two-year yield, for example, spiking a little bit. Not a lot of material pricing changes around the Fed. You have consumer confidence numbers separately also showing maybe the opposite, but maybe the same, right? It's a multifaceted coin. Consumption and exports driving U.S. growth on your screens. GDP, of course, coming in north of 4%. Quite a substantial beat looking at where the estimates were. To just help us understand the context here, Jill Deesis, our managing editor, is with us here on set. Good set of numbers, good growth?
Yeah, I mean, look, I think, you're looking at GDP growing at the fastest pace in 2 years in the third quarter. So obviously some pretty robust figures there. But what you're really looking at here, David, is that the economy did seem to continue to build some momentum. And that's after some of the most severe of the Trump tariffs were actually lifted. So there was a little bit of a reprieve there. Not really a ton of impact, you're seeing from some other political issues. I think, what we're likely to look at is sort of that continued sort of strength as you start to head into 2026. I think the consumer confidence divergence, though, is quite interesting. Maybe tells you a little bit, David, about how the way that people actually spend, because part of the strength in these GDP figures was really because there was more consumer spending. But maybe there's a divergence there in how people are actually spending versus how they feel about the economy. I mean, certainly some concerns there in those consumer confidence numbers about the labor market going into 2026, tariffs, that kind of thing. But at least, that's not showing up in that spending figures just yet. So it tells you a little bit there. Yeah,
just some breaking news right now. So a judge has upheld the White House's 100,000 fee on H-1B visas, of course, which is a story, of course, that made a lot of waves globally when it was first introduced out of the White House. And it seems to be that will remain the case moving forward. Jill, Armimia, you want to comment on this, or should we talk about the weakness in the K-shaped recovery and what it means for the Fed? It's your choice.
Yeah. I think we could probably move on to the Fed as we kind of start to digest, exactly, where this kind of goes in terms of the court decisions here for this visa rule. But when we're talking about the Fed here, I think some really interesting comments. Obviously, we're all kind of, on tenterhooks waiting for Trump to actually announce whoever his Fed chair nominee is going to be. You've got really the latest comments from Trump. I think were, very, very, in line with what we've, come to expect from him, essentially saying that no matter, what the economy is doing, essentially he wants whoever his Fed chair pick is to really, really rally for cutting rates. Obviously, I think some divergence there with, some market fundamentals, certainly over the last, several decades,
It's
David.
not that bad, the economy.
But I think that, what we're really hearing from Trump is just that he is so adamant about wanting to have somebody in that position who is going to do what Trump wants him to do, right? I think he wants lower interest rates, and he wants to install somebody that's actually going to tackle that. Of course, David, I mean, we've talked, I don't even know how many times about the fact that, it's obviously not just the Fed chair himself that, makes those types of decisions. You have to rally the rest of the FOMC around you to, sort of bring something forward. But it does indicate, obviously, Trump is really, really, really wants a Federal Reserve that's essentially going to do what he wants. Does he get that in 2026? I think we'll have to see.
It is just one vote to the point you're making, right? So just looking at the dots too. Thank you so much, Jill. Fantastic. Jill Deesis there, managing editor. Now, we might not even need to crowbar in lower rates, right? Because there is a case to be made for lower rates. In fact, post these numbers that did come out, of course, on consumer confidence specifically, our team at Bloomberg Economics, let me just paraphrase this and shortly, quite simply, is that because of the consumer confidence numbers and the weaker side of things there, a function of labor market health, which is important to the Fed at this point in time, given the mandates, plural, they do expect more rate cuts and easing in 2026. Right, speaking of 2026, a market outlook for next year with VS Partners coming up here and why they think Chinese markets are just starting to win over some long-only investors. That's coming up, counting down to the open of trade. Shanghai, Shenzhen, and here in Hong Kong, this is The China Show. Good morning. Good morning, 17 minutes to the opening bell. Again, a reminder that it's a shortened session here in Hong Kong today. I think we're shut at lunch, and then, of course, that allows us to ease our way into the stillness of Christmas Eve. Well, I guess depending on what your plans are. Certainly in my end, it's going to be quiet. Copper on your screens, of course. We'll talk more about the commodities rally, but certainly when you look at the commodity complex and the overlay on equity markets, resource-heavy markets did also do very, very well this year, right? So whether that's precious metals, you have copper, that's an AI power play. As it pertains to AI, obviously has been doing very well. We're called lower right now across these benchmarks. Asia Pacific, though, is up 0.3% this 24th of December. To get an outlook for next year, Vanessa Xu is here with us on set, co-founder and CIO at VS Partners Hong Kong. Good morning. Very nice to see you.
Very nice to see you again, and Merry Christmas.
Yes, 好久不见. Okay, this year has really been dollar weakness. Stocks have done well.
Yes.
EM has done well.
Yes.
Do you think EMs still have room to rally against the backdrop of just things are no longer as cheap as they were at the start of the year, broadly?
Well, I think the EM good performance will continue because of the fundamentals, the driving earnings expansions and driving credit expansions. When dollar is into a easing cycle, regardless of how much and how fast that Fed cuts, will provide a liquidity support, and the DM market, particularly U.S. economy, is healthy, albeit some cyclical slowdown. So that provides the demand support for the EM market, and there is a difference of this growth cycle, which is it is the DM, particularly the U.S., that has undergone massive expansion on infrastructure, constructions of manufacturing sites, data centers, and expansion on industrial assets and the rebuild capital formation. Right? So that's gonna have demand effect on the EM supplies. So exports are going to stay healthy, which, the EM supply from industrial will turn that into consumer spending power growth, wage growth, middle income households wallet growing, right? So that's going to provide a fundamental healthy support for EM.
What if the Fed doesn't cut anymore? What if they've ended it?
Even if the Fed doesn't cut, I think we have passed the peak rates, perhaps, right?
Okay.
And inflation expectation has been so far well anchored. Even if the Fed doesn't cut, the U.S. fiscal expansion is there, and the liquidity is changing from monetary liquidity that flows into the financial markets to fiscal liquidity that flows into the real industries, to the Main Street rather than Wall Street, right? So Wall Street is a asset price inflation, and Main Street is a real economy expansion, which is going to support demand. I think also the DM has survived the peak rates. Right? Balance sheet has been improving, profitability has been solid, and cash flow has been solid after corporates has survived of the peak rate. Remember, 2 or 3 years ago, we were worried about debt refinancing walls, that corporates couldn't survive the high
post-COVID,
post-COVID and we had the peak rates. So that and bankruptcy did not pick up.
Yeah.
And corporates from our fundamental research has survived that cash flow and the profitability blow.
Okay.
So that's going to support the EM demand. So for example, India is perhaps lagging in the EM with the size. But fundamentally, I think India will be picking up in terms of less restrictive regulatory environment, more liquidity because the central bank has cut, and a solid household consumption growth.
But India, just to play the devil's advocate, has underperformed this year because it neither has a strong AI component in the market, nor is it a very resource-heavy index, for example. So,
right.
Yeah, right. So what's the case for India?
The two prominent sectors performed very well. That India is relatively weaker. But fundamentally, India is at a credit expansion cycle, is at an infrastructure building cycle. The housing market, which in any economy, housing market is a pillar for the economy. After 10 years of down cycle, India's housing market is booming. Therefore, it will have impact on consumption, impact on construction, impact on durable goods such as cars and appliances, etc. So the fundamental has been there. I think MSCI India's earnings growth has been revised up, and the financial sector, industrial sector, and has been doing very well. So maybe next year, I think India is a worse look on a relative value basis, particularly given the other EM market has gone up pretty much.
Can I ask you about China?
Sure.
There's a big swing in attitude from this uninvestable tag to certainly a lot of long-only investors have not only increased allocations, they've at least explicitly talked about wanting to also increase their allocations even further. There's still question marks.
Yes.
I think the point you made, and I think the point you're making is China does not have to be in a bull market.
Yes.
It just doesn't need, we just don't want to be in a bear market. As things stand, do you see more allocations going into China next year, even if the macro stays the same?
Well, you mentioned wanting. But wanting and doing, there is a gap. Right? So when the mind begins to change, it takes time, particularly for large, very fundamental, long money, to realize perhaps the risk allocation was too bearish and too little for China to actually at a IC or CIO office level to change the risk allocation and take actions of that takes time. So I think China rebounded since September 24 last year. So it's slightly more than a year, and the export industrial compound remained healthy, although domestic economy still have some headwinds. So it has triggered people to deeply rethink about geoeconomics, rethink about how to look at China's fundamentals, and that takes time. I think as long as next year it is not a bear market, even if it doesn't, the market doesn't go up as much, it will have a people will allocate to China more, particularly in the broader context, as we mentioned, the EM. Still, this is the largest EM component, and for sizable capital to deploy to EM, China has to be a must go.
Is it a beta play next year? you think? Is it a benchmark play, China?
I think it's an alpha play. Look at the economy. There is a bifurcation.
Right.
Advanced industrials, chip makings, semiconductor-related value chains are doing very well. It will continue to do well. And we see a very healthy and strong, high-quality pipelines of IPOs coming to Hong Kong or domestic market for that matter. But on the other side, the consumption remains still, a little bit weak, and real estate continue to have dragging effect on the traditional economies. So it's a alpha market for stock pickers.
And it's a play mainly in Hong Kong because Hong Kong has had, to your point, massive IPOs this year. It's been a very, very good year, and I think you think the world underappreciates the fact that the market structure in Hong Kong is changing.
Correct. And the market structure changing, meaning that, Hong Kong used to be perceived as, massive state-owned companies, the traditional banks and insurances. And Hong Kong is lacking innovation, and the innovation goes to starboard in Shenzhen.
Right.
But now look at Hong Kong. It has a very well-rounded industry combination of the new issuances and the reissuances. So you can find leadership almost across board of all industries. So the innovation force is driving the Hong Kong IPO market, and the world has not realized that. I'll give it another year or two, the world will realize that very strongly, that Hong Kong market structure has fundamentally changed.
Okay, yeah. We're out of time. We didn't get to talk about private credit, alternatives, and fixed income. No doubt we'll have more time for that next year. Vanessa, very nice to see you.
Very nice to see you too. Merry Christmas.
Merry Christmas. Merry Christmas. Hi to the team for us as well. Vanessa Xu there, co-founder and CIO at VS Partners here in Hong Kong. We are flat on the Hang Seng at the open. A50 futures are down about 0.25%. Plenty more ahead. A preview of the session. This is the China Show. Good morning. Right, welcome back. Going into the open today, so 7 level on the currency, we're close. It'll need to be a fairly statistical aberration-esque day to take us below 7 on dollar China. We'll talk about CNUC and MGM China in a moment. We talked at length already about precious metals. There's a 7-year bond sale. I think it's 88 billion renminbi today, and of course early close. So we open at 9, and then I think we shut at 12. So 3 hours for today. All that is to say, it doesn't even matter if the market is open, right? Because investors have largely checked out. So we talked about falling vol and turnover. 15-day moving average on the Hang Seng Index turnover charts coming up on your screens. Green circle, well, Christmas theme, right? Green circle was the peak this year. That's the deep seek moment from that low. And red is where we are, and we're at the lowest level, going back to about the start of the deep seek moment, right? We've almost come full circle on turnover, but again, on price itself, we're certainly holding up near the higher end of this year's range in the Hang Seng Index. In fact, just on that very note, have a look at where we are here. 26,000, let's call it that, Hang Seng Tech on your screens, dollar China and Hang Seng China. So we're slightly, and I'm being generous clearly, going into the open today. The opening bell coming up next, 3 minutes away. This is the China Show. Good morning. Right, each and every day, well, not each and every day, let's call it more often than not, I get reminders of how blessed I am to be covering a region as diverse as the Asia Pacific. While we were looking at Japan for potential intervention, we were looking at China for a potential break of 7. What happened was the Koreans came out and gave us those conversations to have separately. But yes, that is just to say, of course, lots of stories to get into as we wrap up even a very, very quiet session in the equity markets. There's a massive move down in dollar won today. We were, I think, 1.3, 1.4% to the downside there on dollar won. Okay, that is also to say that it has been outside of that, it's been a weak dollar story going into that one story this morning. Dollar's weaker a third day. You had the fix, at 7:01. I've talked about this in case you missed that. That's about a 1 sigma move away on a daily basis that takes us below 7. There doesn't seem to be anything on the agenda. Clearly, we don't know what we don't know, but doesn't seem to be anything that is visible that might act as a catalyst for a 1 sigma move down in dollar China today. As you look at the bond yields and as we change the page, just a reminder that we have a 7-year CGB auction today. Keep an eye on that. 88 billion being on offer. 10 to 1% to the upside, just 200 short of the 2,600 level on the Hang Seng Index. It's quiet as far as sector news. There's chips and, of course, there's drones, which I think we can get to later on as far as the movers go. Obviously, precious metals, that's a separate but related story. CNOOC is up 0.3%. Another oil discovery in the Bohai Sea. Not much reaction in the market today. One debut coming through. Ningbo Jansen on your screens. We're up 200+%. Beyond that, I can't tell you more. Really, it's the first day of trade, so let's flip the page, please. But suffice to say, it's another good day. Good trading debut there. Chip stocks in focus. There we go. SMIC up 4.3. Hua Hong is up about 4%. This has been a fairly consistent move, by the way, since the More Threads unveiling of their new product on the weekend. Now, we talked about gold, right? 4,500s on spot. Silver's up 71.72. So gold's up, 70%. Silver's up by double. Jiangxi copper, 1.4%. Putting everything together as far as the copper story is concerned, 12,000 on copper. There we go. Thank you. 12.1, and of course, also I think we're at 90,000 on a Shanghai contract. Let's bring in our cross assets reporter, Richard Henderson. He's in Melbourne for us today. Richard, good morning, sir. Thank you for coming on the show. Cross asset has been a very busy area this year. Take your pick. Where do we start going into next year? What's top of mind for you, sir?
I think stocks is a great place to start. The MSCI Asia Pacific Index is up 27% for the year so far when you include dividends. And part of it is a dollar story. Weakening dollar does flatter some of those returns. But I think underlying that is a great technology story. And it really is easy to point to DeepSeek at the start of the year that showed investors, and it comes up all the time when I'm talking to chief investment officers and portfolio managers in the region, it really underscored the type of possibilities and talent that's on offer in China, but also in places like South Korea, Taiwan, Japan, where from a hardware and software point of view, it's so tightly integrated into the global technology supply chain, and often at a far greater, more attractive valuation, let's say, than the United States. And we see those persistent concerns around the Mag 7 valuation story, for instance. So I think going into 2026, we're going to see investors really like to build out their tech exposure in Asia, to build on some of those gains, and to potentially try and surf up the AI theme at a cheaper price point, basically.
Yeah, you don't need to look cross asset, just look across the Pacific. Any concerns over valuations? After a year, and let's take Korea. Obviously, it's a very extreme example because I think that is the best performing index, and a lot of that has to do with SK Hynix and Samsung beneath the hood. After a year like Korea's had, are there concerns over market concentration or valuations within that space? Just to maybe just close the door on that one.
Definitely, yeah. Those concerns are going to be very key to the investment thesis for those single names and for the index. But I think we're not really seeing the same levels as we're seeing in the U.S., where the Mag 7 is some 33% of the S&P 500 now. That makes the index so vulnerable to such few companies. There's also great earnings underpinning some of these supplies in Asia. So I think, given that attractiveness of valuation relative to the US and other global peers, investors will still see a lot of value through Asia Tech. So I expect that to continue into the new year.
Okay, what about credit, sir? What's top of mind going into next year? Credit, yeah. Investment grade dollar credit in Asia is heading for its best year since 2019. It's outperformed the US. It's a great year for Asia credit, and part of this is not a huge glut of supply, and also pretty attractive on the defaults. Very low defaults.
So, when we talk to portfolio managers, they really like Asia credit at that investment grade level. But also high yields had a great year relative to the US. I think it's best year in 7 from memory. So yeah, Asia credit's still very attractive. And again, it's partly reflecting the relative attractiveness to its global peers. But I think another strong year for credit potentially in 2026.
It's quiet on equity markets. In FX, though, the news flow keeps giving, and I think that the Koreans, we talked about this, and I'm not sure if you heard what happened there. Of course, the Bank of Korea just now talking about how the NPS was activated, new strategic FX hedging. That's just to say, of course, very, very strong language coming through out of Korean authorities on the currency markets. Obviously, against the backdrop of a very weak dollar this year, does the weak dollar continue next year, and how does it activate regulators that might be maybe too worried over a too-weak dollar, for example, or the opposite in the case, I guess, of the Koreans?
Exactly, and you can point to Japan as well. We had comments this week from the finance minister, I believe, reminding the market about the ability for official intervention. Listen, I think because of the Federal Reserve cuts that are forecast in the year ahead, we're going to see a pretty sort of persistent weakness, outlook for the dollar, and again, relative to some of those Asian central banks, Australia, New Zealand, Japan, that are now shifting or already in a tightening cycle that will support their currencies. I think the dollar weakness trade should endure until we start to see a shift in U.S. inflation or jobs.
Richard, fantastic. Thank you, sir. Richard Henderson there in Oz for us, our cross-assets reporter. Just very briefly, and for many people, sorry may be the hardest word. Not for us. We're sorry. We made a mistake. The graphic that we showed you earlier on that showed silver was up 400%. That did look kind of sketchy, though, to begin with. There's the correct graphic for you. Year to date, that's what we're doing on silver, gold spot, and also copper. But, you know what? Just to say, it's been a good year. Still, right? Okay. Plenty more ahead. This is The China Show. Welcome back. You're watching The China Show. Let's talk about strategic investment. Let's talk about ports, right? So China's invested, billions? Billions and billions of dollars, really, in building ports right around the globe here, giving Beijing a strategic advantage given the trade and tensions conversation. It's sparking security concerns as well around the world. And our team at Bloomberg Originals, in fact, has taken a closer look at this trend.
Every year, China imports about 66,000 metric tons of these. That's the weight of about 6.5 Parisian landmarks, or if you like, 440 blue whales. And most of these avocados come all the way from Peru. This journey used to take over a month. Now it's a straight shot, cutting it by 10 days. Why? One word: megaport. And it's paid for by China.
Well, Chinese President Xi Jinping begins a week-long South America tour, opening a China-funded mega port in Peru.
This is a huge investment, not only for Peru, but in Latin America, and it is expected to triple agricultural exports of Peru.
Over the last 20 years, China has built up a network of about 100 ports on every continent except Antarctica, clustered around key maritime choke points, which are crucial to global trade.
This gives China a strategic advantage as global trade tensions rise. But it's also sparking concerns.
Even though these ports, by and large, are commercial ports, some of them do actually have the capacity to host naval vessels.
So why did China build a global ports empire? And should Washington be worried about it? Without ports, the global economy pretty much grinds to a halt.
Roughly about 80% of global trade is conducted via ships, and ports are crucial to that.
6 of the 10 busiest ports in the world are located in China, and 95% of the nation's trade is done by sea.
China has made itself rich by being able to find markets overseas for its manufactured goods and being able to ship raw materials to China to be processed. So making sure that it has access to a network of global ports is a key part of that.
And it's not only ports. China is also the world's biggest maker of container ships. Making these generational investments to dominate global trade infrastructure is a central pillar of the Belt and Road Initiative.
Over the years, it has become President Xi Jinping's signature global initiative with the goal to strengthen or improve global connectivity through building up infrastructure projects.
This has meant modernizing the ancient Silk Road with highways and rail while securing maritime pathways in and out of China.
Since the launch of the Belt and Road Initiative, Chinese entities' investment in overseas ports have accelerated, both in terms of scale and numbers.
This map shows Chinese entities have invested in 129 port projects, totaling over $60 billion from Tanzania and Australia to Nigeria and Cambodia. This dwarfs investments made by any other country.
There is no U.S. government initiative that tries to finance or build port projects overseas.
China has an entire ecosystem of companies, from cement firms, iron, steel firms that specialize in building out ports. Those are not industries where the US has been focused in recent years.
But the level of Chinese ownership over its ports varies.
China's global port network is made up of a series of different forms of ownership by Chinese state-run companies and also Chinese private companies.
In most cases, they team up with multinational or local companies to build and run the ports, even though the land is still owned by local governments. 17 of the ports China has invested in have majority Chinese ownership, which could offer Beijing more leverage at those sites,
such as prioritizing container ships from a certain country or denying the docking of ships from other countries.
But China has little reason to disrupt global trade, which takes us back to the first megaport we mentioned, at Chancay in Peru. 60% is owned by China's state-run shipping company COSCO, and 40% by an entity controlled by an Argentine investor.
Chancay is located around 40 miles north of Lima, and in its final phase, the main area of the port is expected to be around 700 acres, which is about 80% the size of Central Park. So the port itself is huge. This port is part of China's large infrastructure push in Latin America. Currently, 3 out of 4 of the biggest economies of South America trade more with China than the US.
In fact, a third of all the containers exported by Peru are sent to China, carrying not only these favorites, but other agricultural products and minerals as well. So this makes Peru a crucial gateway into China for Brazil, Chile, and other countries.
The initial investment was of $1.3 billion, but if there's more demand, COSCO has said that it could invest $3.5 billion total for an expansion of the port.
Chancay is a deep water port, which means that shipments could take place directly from Chancay to major Chinese ports. So that would enable journeys to be cut down, costs to be reduced, trade to be increased between South America and China.
U.S. officials have criticized this port, telling Peruvian authorities that they should not have allowed a Chinese firm to create such a big investment in the region. But Peruvian officials have countered, saying that the U.S. hasn't been willing to make such a big investment in Peru.
As we know by now, this is not just a story about overseas investment, it's also about national security.
A number of Trump officials have even suggested that the port could be dual use, meaning that at some stage it could be used not just for economic activity, but for military activity too. That's something that Peruvian officials strongly deny, and that China denies too.
But these concerns are not unfounded.
Well, U.S. intelligence says China's first overseas military base in the tiny African country of Djibouti is likely to be followed by several more.
In Djibouti, what began as a commercial port eventually turned into China's first full-fledged overseas military base.
Remember this map? Of the 17 ports with Chinese majority ownership, 14 have potential for both commercial and military use.
Meaning it can service commercial ships, LNG tankers, oil tankers, and it might also have the physical capacity to host fueling ships, logistic ships for military purposes, or a military battleship.
China only has one overseas naval base so far, as compared to the several that the US has dotted around the world.
In fact, the U.S. also has a naval base in Djibouti, along with at least 127 other overseas military bases. Chinese officials strongly deny that the ports are for military use, but still,
many countries around the world are concerned that these Chinese port operators could in turn become listening posts to what the economies that are surrounding these ports are doing.
But the more immediate concern is that China could leverage these ports in a trade war.
China is operating the Panama Canal, and we didn't give it to China. We gave it to Panama, and we're taking it back.
For the US, the Panama Canal is really a crucial economic lifeline. Something like 5% of global trade travels through the canal, and 40% of US container traffic flows through it. Without that ability to easily pass between the Atlantic and the Pacific Ocean through that corridor, US trade would be very much impacted.
Two of the ports on either side of the canal are owned by Hong Kong-based conglomerate CK Hutchison.
To all intents and purposes, Beijing doesn't have direct control over Hutchinson. But the very fact that the key executives at these companies may have direct relationship with the Chinese Communist Party, that really makes a lot of Western governments uncomfortable.
A foreign power today possesses, through their companies, which we know are not independent, the ability to turn the canal into a choke point, and that is a direct threat to the national interest and security of the United States.
China has said that it has always respected Panama's sovereignty over the canal and that it firmly opposes economic coercion and bullying practices. Yet, it has also pushed back against a deal that would give control of CK Hutchinson's Panama ports to American asset manager BlackRock, calling the deal a betrayal of national interests.
The European Union has introduced investment screening regulations, which make it much more difficult for China to buy up critical infrastructure, including ports, across the continent.
A tit-for-tat over docking fees has also been rippling through the shipping industry. Washington has also suggested that all this Chinese money comes with heavy strings attached.
But if you talk to officials in Nigeria, Peru, beyond, there's a feeling that, look, we need this infrastructure, it's important for our economic modernization plans, and China's the only game in town offering it.
Ultimately, we're going to see a reshaping of global trade flows because maritime trade has become more and more political.
Enjoy that? Yeah, fantastic stuff and work, of course, out of our team at Bloomberg Originals. Subscribers, by the way, can watch that specific one and others, of course, on the terminal. It's also on the website on Bloomberg.com. China has certainly emerged as really one of the key markets this year. That's on ports. Do, of course, catch and read up on Shuli's column today, a fantastic one. Repeat after me, never, ever underestimate China, of course, in terms of what happened this year. Trade war, AI developments, everything in between. The latest article focuses on why one should not undertake that exercise. You can read about that on Terminal as well, also on Bloomberg.com. Right, welcome back. Chips in focus. Well, a couple of things. Because obviously, one is the U.S. has, at least for now, pushed back the prospect of duties on that following, of course, the review. The second one comes down to what the Securities News reported late last night. And also SMIC, in fact, raising some prices, some products by 10%. More on those stories coming through in the next hour of the China Show. Welcome back. You're watching the China Show, half an hour into twas the night before Christmas, as they say, and certainly volumes are screaming that fact out. When you look at turnover turning down, volumes at this point in time of the day were about 48% lighter than the month's average. Price swings obviously are going to be exacerbated, but that's just to say, of course, markets have effectively checked out for the year, and it's been a really, really, really good year to be long major assets like stocks, precious metals. We'll get into all of that, of course, in the next hour of the China Show. And, of course, Belle is standing by in Sydney for us to help us drive the ship in the next hour. Belle.
Drive the ship for the last show before Christmas, and definitely here in Australia, people have well and truly clocked off by now. But we are going to be bringing you all of the market moves over the coming hour, and just starting us off in the session today. Yeah. I mean, it's pretty strong, and we have really eventually got that Santa Claus rally, it seems, just given what we had on Wall Street. It's translated eventually across to the Asian benchmarks in this session, with the exception actually of the ASX 200 standing out to the downside this morning. But it is that continued theme you see around tech in particular. Metals and Vietnamese stocks, we're also tracking those. Let's actually get to Vietnamese stocks first, because as you were saying, Dave, I saw your email you sent earlier. This is by far the best performing benchmark globally over the past few weeks. You're seeing gains of around 7%, but even in the session today, very strong moves. And this is really perhaps with a little bit more political clarity coming to the fore here, because we may be soon set to get a new picture, or a clearer picture of the new top leaders for the country as well. Metals, as I mentioned, because very strong moves across the board in the likes of copper, palladium, or platinum rather, silver, gold. I mean, you're seeing platinum record high, silver above $70 an ounce, 4,500 on gold spot as well, copper above 1,200,000 a ton for the first time ever. Very strong moves, really, with these expectations around Fed easing into next year. There are some tariff risks as well that are coming to the fore, particularly for those copper prices, but also taking a look in the currency space, because again, as you said, Dave, you get that thinner trading, it leaves you open maybe to some more stronger moves, and the Korean won is maybe reflecting a bit of that today, but it is strengthening, and that's after authorities said excessive weakness in the currency is not desirable. So some strong determination to act. I mean, we just got that early this week as well from the finance minister in Japan, but certainly you have those government officials in North Asia prepared to step in.
Absolutely. In fact, Mark Cranfield is standing by for us to help us understand the context here in terms of what's happening broadly, of course, risk assets, and we talked about the FX markets and the complications suddenly of us looking elsewhere. Mark, we were looking elsewhere for intervention. Japan is a good example. We were talking about 7 on the Chinese currency, and then the Koreans came out and said, hey, look at us. How do we need to be looking at this risk?
Well, the Korean timing is very clever indeed, because they obviously were waiting to some extent for a change in the Japanese currency. The two are usually pretty closely linked together. So since we've already had Katayama, the finance minister, helping the yen to get a little bit stronger, the Korean authorities are following up. And their timing is also good, because if you look at the performance of the dollar against the Korean won over the past year, you'll see that when it gets close to the 1480 kind of area, which it was approaching today, that's a pretty important pivot area. And if they had allowed it just to drift even beyond that, by the time we come back in January, we could have a very weak currency indeed, and it may be beyond their control to do anything about it. So very important that they step in when they did. And if you look at the measures that they've announced today, that the key one is the one that's aimed at individual investors. There's been talk for quite a while that Koreans have been sending a lot of money to the US to buy tech stocks in America. It seems that the individuals in Korea, they love American big cap tech names, people like Tesla, Nvidia, all those kind of players. And there is so much money stored up in the US dollar via the equity market the Korean authorities are now encouraged them to bring it back to Korea and do so at advantageous levels as well. So clearly it's very much aimed at getting money back into Korea to support the Korean currency. So very good timing from their point of view. So the chances of them drawing a line under the weakness in the currency is pretty good as they go into year end, and they should be able to start the new year on a much better footing than they would have done if they just allowed it to drift around.
Yeah, let's talk about, I guess, some other implications of that weaker dollar story as well, because you've got gold that's above 4,500 an ounce for the first time. What does that tell you, and what's the direction for metals going into next year? Because a lot of these moves, I mean, again, at record levels.
Yeah, I mean, that's a double-edged thing there. So general US dollar weakness usually is good for precious metals, especially gold. But you're seeing it branch out way beyond. It's going into, as you say, into silver, platinum, and other places as well. So on the one side is a dollar story, but on the other side, clearly geopolitics is playing a pretty big role as well. The fact that the United States and Venezuela, the situation there is pretty tense, could even deteriorate further. People are concerned about that. And then you've still got a lot of unresolved issues in other parts of the world. There seems to be no sign that Russia and Ukraine are going to have a truce there either. So there's plenty of reasons when you look across the world. If people want to be nervous, if they want to be defensive, then obviously going into gold and other places is pretty good. And then you get the double whammy effect because the dollar is falling as well. And in the background, the Treasury curve is pretty stable. And one of the few things that can derail the gold rally would be if suddenly we get a big jump in Treasury yields. That doesn't seem to be happening right now. People still think the Federal Reserve is going to lower interest rates again next year. So all the conditions are very much in favor of gold and silver staying on a pretty good track for the time being.
Mark, I'm just taking a look at crypto prices and Bitcoin in particular. It's actually pretty incredible given all the optimism we had around crypto going into 2025 and the expectations of where it would end the year. It's actually managed to go lower by around 8%. What does that mean?
I think if you've been following what we're saying on Markets Live for the past few months, crypto is a side story. I think there's enough happening in major currencies, in equities, in global fixed income markets. There's enough asset classes which are looking very, very interesting. Crypto is a sideshow. People are just moving their money away from it. It's increasingly becoming less relevant to what happens in the other markets. It's no longer really a cross-asset story. It's out there on its own. There are people that like crypto, they want to be involved. The read across for other major assets is becoming less and less all the time. So with that background, you can have crypto continuing to slide lower, and frankly, bond traders, FX traders, they don't really care.
Really great. Love that, Mark. That was our MLive strategist there, Mark Cranfield, in Singapore. And I think just saying that there's a lot more interesting asset classes to track leads us perfectly into our guest. We've got Masahiko Liu joining us, senior fixed income strategist at State Street Global Advisors. So, Masa, I mean, you just heard Mark telling us straight there's just too many more captivating stories in markets to grab traders and investors. What's most interesting for you in the fixed income space?
I think fixed income space, right, is a carry and income story. We have seen a lot of, sell-off fixed income, especially in the DM market, and EM market too is a pretty interesting place to be for next year, right? And then there's a lot of talks about diversifying away, not divestment, again from U.S. Treasuries, right, into different parts of the world. We have, EM as a substitute. We have seen investors, moving into gold. You have been investors trying to move into a bit of foreign flows into JGBs actually lately. So I think you go into next year, fixed income is still a carry and income story, and then with yield at this elevated level, I think it's a good entry point for investors with long-term investment perspective.
So we're setting up maybe for a bit softer dollar story as well. What does that tell you about the preference for EM versus DM?
I think for EM market, if you look at the total return year to date, EM local currency has returned around 18% this year, 18%. And if you look at something like global ag, right, global aggregate is up around 8%, which is more carry and roll. And the reason why EM local debt has outperformed is because of dollar weakness. We do think that with a slightly dovish Fed into next year, we at State Street we actually had a pretty out of consensus call of 4 cuts in 2024 and 2025. We had 3 cuts. This is from our chief economist Simona, based in Boston. She had a pretty good call this year, right? Despite all the ups and downs in the market where people pull back their rate cuts forecast, we stuck to our guns. And then into next year, we do forecast 2 to 3 more cuts from the Fed, and that will probably embark a slightly weaker US dollar, maybe 5 to 7% weaker from here, and I think that in the world where you have Goldilocks growth and then a slightly weaker dollar, and that will actually benefit EM local currency debt as a whole, especially when a lot of these global investors, remember, they are they are still underweight under emerging market debt. So it's an asset class that is underowned. It pays high real yield, and then there's more room to appreciate versus the US dollar.
Fantastic, Masa. Of course, we'll have more from Masahiko Liu in a moment there. We've largely had a look back at this year, and he's somewhat teased, of course, some of the areas of the market that he likes going into next year. We're underweight globally, of course, EM. As you can see across the fixed income space, high yield has done better than most. Does that continue to be the case in 2026? More on the outlook coming up next. This is The China Show. All right, welcome back. You're watching The China Show, our final full broadcast, by the way, of the year. So it's Christmas, and let me find a way to crowbar my favorite Christmas movie of all time and the conversations around the Fed. Might more FMOC members turn out to be doves, actually? Masahiko Liu is still with us, senior fixed income strategist at State Street Global Advisors. Masa, thanks for sticking around. I think you just mentioned in the previous segment 2-3 rate cuts for next year. Almost everywhere has done well across the fixed income space, high yield and everything in between. When you look at consensus right now and you look at what markets, most people are expecting, what could go wrong?
I think next year, the things that might go wrong is, we do have like air bubble burst, right? Albeit this is not our base case scenario. Our theme for next year is uncomfortably bullish. So we are still long in risk assets, and we do want to have some hedge though, right? So if you have that, small bubble burst, or call it a momentum crash rather than burst, and then there's also talks about yen carry trade being unwound, which is, I don't think we will see that. We might see a bit of, periodically volatility, but it's not a systemic or structural risk that per se. So if we do have that, small turmoil in the market, that's when, risk assets will do worse, right? And then that's when, hedges will come in and do well. And that's why we have seen investors, locking into having trades like, they are long risk like equities. And then, if you are long, say, for instance, the short end of the U.S. curve is a pretty good play, right? If risks plunge and Fed will cut, right? So that's a pretty good place to be. For fixed income, has its place, albeit not in the longer end of the curve, but the shorter end of the curve. And other asset classes, like fixed income that has cheapened up a lot, like JGBs, for instance, right? If you do have a change in sentiment, I think that rewind, that reversal will be pretty quick. And also, you can sit on assets like hedges, like gold, and convertible bonds, right? We have seen actually investors, especially in European investors, taking chips off a bit on, when it comes to U.S. Equities, right? Growth equities. And then if you are in converts, you do have that upside in equities, and also you do have a downside protection of a bond-like downside protection, right? So that's why we have seen, a lot of investors trying to have hedges on.
Well, fantastic advice. I think, can I just pick up on one of the points you just made? It's the short end. So I think we've seen 3 straight years of the U.S. curve specifically steepening. Do you see anything that upsets that trend? Are we going to get a 4th year steepening?
I think, we will get a fourth year steepening into next year, albeit, a flattening is probably more of a 2027 story, right? Even in Japan, the flattening is going to be a late 2026 story, right? I think, globally, you still have a lot of fiscal slippage and a lot of issuance in the longer end of the curve. That'd be US, Germany, including Japan too, right, where I sit in, right? And that's why we think that the curve remains distorted, albeit, there's a lot of fixes or like tweaks being done, you can cut a bit of the issuance on the back end and issue more, in the bills, like so cut coupons and issue bills. A lot of these, technical things can happen that could contain the steepness of the curve. But, in general sense, I think a lot of people are comfortable sitting on the shorter end and then having to price a bit of term premium in the longer end.
Yeah, I guess that's also a reflection around the yield curve outlook, just of a lot of the spending that's tied to the big, beautiful bill that's going to kick in, and a lot of what we see in terms of AI CapEx investments as well. As an investor in more of the corporate space, is there any concern about some of those bonds that are tied to AI specifically?
Sure. Like at State Street Investment Management, we favor sovereign bonds over credit for the next year. Right. The reason why is because we have seen a lot of issuance, funding, especially for hyperscalers in AI capex, and that I think will drive spreads higher into next year, especially focusing on the tech names that will basically drive spreads. When it comes to, like, for instance, US IG, right, it's trading around 80 basis points, 75, 80 basis points, almost at all-time tight. Right, I think the general direction of travel is to get spreads a bit wider, maybe to 100, 120. When it comes to high yield, it's trading at 275 currently. It's also at all times tight. So there's only that much room for it to rally from here further, to tighten further. So we do think that if we do have a bit of more cockroaches in the market per se, and then more issuance, that will basically put on some pressure in the credit market. So we are favoring sovereign debt over credit, and then we also favor EM local debt and other hedges like gold and converts.
What about the Japan debt market as well? Because I can see in your notes you're saying JGBs look pretty cheap, but sentiment does still remain pretty cautious as well.
This is something very interesting, right? Talking to foreign investors. So me sitting in Japan, so I cover APAC and do travel to over to US and Europe from time to time. Talking to investors, you have seen two types of investors, right? The domestic and foreign. Foreign investors, they are getting more attracted to JGB market, albeit a lot of the money that flows into Japan from foreigners, they are still in the fast money, or the ones that are active, more tactical type of investors. We do sense that there's more and more of the real money, right? The likes of the sovereign wealth funds, like your pension funds in the US, right? That has never been looking at JGB for the past 30 years because it's yielding at 0%, right? Now suddenly it's yielding at par with Germany 30 years, right? And then if you're foreign investors, you hedge it back to your own currency, home currency. You actually get the hedging premium, which is around 100 to 200 basis points, of attractiveness. And as a domestic investor in Japan, no one wants to catch a falling knife, right? Japan banks are sitting on a lot of cash, 400 trillion yen of cash, right? Those are the money that will be deployed in the JGB market. But speaking to investors in Japan, we have started to see this pickup of interest, but then it's going to take a long drawn process. They have to wait until BOJ gets to closer to the terminal, which is, we think, around 125 by early 2027. So, JGB, that you get structural buying from Japanese investors will be a 2026 later half story. But before we get there, there's a lot of entry points for investors to get in when especially when the market, JGB market sell off under a headline of increased issuance of fiscal slippage, right? For us, we think that Takaichi, if she has a choice, I don't think she wants to be a Liz Truss, right? I think she's going to be a Meloni, like how Italy has outperformed the market coming into this several quarters.
Yeah, that seems to be an easy choice of preference. Let's put it that way. Can I just, perfect segue from the JGB market to CGBs. So obviously we've seen this yields cross because of the sort of Japan normalizing interest rates, the lack of inflation in China on our screens for our viewers. Masa, you say 2026 becomes the verdict year on China's ability to exit deflation. Two-part question, do you think they will exit deflation? And if they do, what's the trade? And by the way, third question, why 2026?
I think 2025, right, has seen, look at the chart, right, it's pretty surprising, right? Like, to me, is eyebolic, right? It's very symbolic. Chinese yield is trading underneath Japan, right? JGB is actually yielding more than CGBs, right? And I think 2025 is the year that, investors have shifted away from thinking the segment of Asia is actually Japan. For the past 30 years, right, no one's, Japanese yield is next to nothing, right? Now, Japan is actually doing a lot better. There's a lot of foreign, inflows into both JGBs and also Nikkei equities, right? And if you talk to a lot of foreign investors, they are actually pretty bullish when it comes to Japan, especially when it comes to macro growth and stuff. But shifting to China, I think, is actually, there's a lot of similarities, a bit of differences between Japan and China. And sitting in Japan, looking at China, I could see China is mimicking Japan back in the 1990s, early 2000s, right, where Japan was in the initial stage going into the lost decades. I think 2026, is the verdict year because, we have seen China's inflation improving a bit, right, but still, it's still in the deflationary stage. And there's a lot of targeted spending, targeted growth initiatives done by the government. And 2026, if anything, we think it's going to be a pivotal year for them if they could actually exit deflation and also induce a bit of growth in the market into its economy. But putting every piece into the puzzle, we do think that 2026 is still a pretty. It's going to take a pretty long time for China, right, to exit that whole deflationary and also growth undermining mindset. Just because of how, look at Japan, right, you have the demographics, aging society, and you have elevated debt, and then the third one is secular decline in potential growth. China is doing better in Japan, right, because they still have 4 to 5% potential growth. But then there will be a lot of pressure, external pressure on China, and we think that CGBs is actually attractive trade to be whenever there's a sell-off, taking from the experience of Japan on the JGB market.
Masa, thank you, sir. Have a good rest of your week and holidays ahead. Masahiko Liu, their senior fixed income strategist at State Street Global Advisors in Tokyo. Right, we'll leave you with a look at markets, and then we'll see you on the other side of this break.
Welcome back. And some of the corporate stories that we're tracking this morning. We're watching CNOOC shares. That's after it announced a major oil field discovery in the Bohai Sea. CNOOC says the Qinhuangdao 29-6 holds 100 million tons of oil, with a discovery well producing 2,500 barrels of crude a day. China's COMAC is set to miss its annual delivery target for its C919 single-aisle jet by almost 50%. Data from Cirium and Planespotters.net suggests COMAC shipped just 13 of its flagship plane this year, well short of the target of 25. Plane makers expected to have received the C919 this year, including Air China and China Eastern.
All right, let's have a look at these markets. Chips in focus. SMIC had the news yesterday out of the Securities Times that dovetails really into first the jump in the shares clearly, and some prices on some products by 10%. Bake that into your models. Hua Hong Semi is also on the up here, 1.2%. Taiwanese insurers also in focus today on the back of some changes in, I guess, FX, and that it should be leading to some gains, not all, but we are coming off highs, if not completely reversing in some cases on some changes in accounting rules. Right, we'll take a short break and have a look at the Japanese close, the morning close in a moment. This is Bloomberg.
It's 11:29 a.m. in Tokyo this morning. Japanese markets just about to go into their lunch break. We're not really seeing too much trading activity, and we're seeing holiday thin trading across the board. No surprises why, of course. It is Christmas Eve, but still we are just seeing stocks inching marginally higher, and that's after we had some pretty strong GDP figures out in the US overnight that set us up nicely and played in again to that Wall Street session. Asia markets as well. Let's take a look at what's happening across the board today. As we said, it's very light in terms of news stories, but still it's just some incremental moves here to the upside. You're still seeing that continued outperformance of tech there. And of course, the commodities rally is the other big story that we're tracking here, Dave.
Yeah, it really is. In fact, we're going to get into that in a moment. There would really, as recently as a few weeks back, I thought we were kind of done with the rally, and then the last week happened, and here we are, 45 on gold, 4,500, silver 72, platinum, copper 12,000. Equity markets, just very quickly, of course, in case you want to take, if you're keeping tabs, best year since these years on your screens. Clearly, the Kospi's had a standout year. I think it's the best performing major benchmark globally. And yeah, clearly the best on price this century, in fact, and the rethinking of its role specifically, not so much as a tech play, that's been a consistent theme for many years, flip the page, but as a really vital cog to the AI supply chain. Gold, there we go. It's been, the fact that you have an underperformer, the fact that gold has seen 50 record highs, and it's still one of the underperformers relative to others like silver, just tells you how good things have really been, Belle.
Yeah, and let's get more on that gold story and commodities generally. Bring in our Bloomberg metals and mining reporter, Martin Ritchie in Shanghai. So, Martin, was this something you had thought would be the case? We'd see $4,500 an ounce by the end of the year, and how does that set us up into next year when you've still got more bullish calls saying 4,800, 4,900 is even possible?
Yeah, it's been a pretty spectacular year for gold, and since you asked if I'd ever thought about that, one of my colleagues was mentioning this morning that when he covered gold, you can never imagine prices at this level even 2 years ago. But here we are, and I think this December rally that you've seen in gold and in the precious metals is really a kind of continuation of the same themes we've seen throughout this year. It's about the debasement trade, it's the growing sort of mistrust in traditional assets, the sovereign bonds and currencies. It's about the weaker dollar. It's about central banks buying gold because of those things, and it's about a little bit more of private investor money coming into gold. But you have all that, and then you have kind of low liquidity in the end of year season, which means that these kind of momentum trades can take hold and spread to other metals. We've obviously seen silver, platinum, palladium, all these precious metals that are very small markets and can make very big moves. We've seen those start to make pretty spectacular moves, in fact, in the last few days.
Yeah, and when they use a spectacular, could sometimes be an understatement. Just tells you how good things have been. Martin, let's talk about copper. Obviously, we all know about the supply issues there. The three biggest copper mines in the world. Is there? Well, when I look at the economic forecast for next year, then this is the economic overlay. People seem to have a mixed view on whether the global economy will do better next year compared to this year, and I wonder whether there is an economic consideration when you look at Dr. Copper doing what it's doing to the upside.
I would actually take this opportunity to talk a little bit about the downside for copper. We're seeing this rally to 12,000, well past 12,000 already. We're seeing this happening even as demand for copper is quite weak, especially here in China. We've seen over the past 2 months a really quite marked slump in demand, and supply-driven rallies, especially when they're driven by a kind of time-limited thing like the prospect of US import tariffs, are maybe not that reliable. And there's already a lot of people saying, look, 12,000 is just too high for copper. It's higher than where it should be relative to demand. If we look globally at supply, the market is not that tight. It's only because there's a lot of stuff going to the US to front-run tariffs that you're getting this sort of slightly distorted sense of where prices are. So those are all reasons to be kind of a little bit more cautious, I guess, about next year with copper at these already very high levels.
Martin, thank you. Martin Ritchie in Shanghai for us, our metals and mining reporter there. Right, just ahead here, we're having, so when we talk about a closer look, really a closer and deeper and comprehensive look at CATL specifically. So the company's taken on new heights this year. It's setting its sights then on further expansion overseas. But there's some speed bumps, some bottlenecks ahead, including politicians and Donald Trump in the way. Details on that story just ahead. This is Bloomberg.
You're watching the China Show and taking a look at some stocks that are moving very strongly to the upside today. These are smart driving stocks listed on the mainland. But the story here and the reporting we're actually getting from Xinhua is that the Beijing City has issued the first batch of license plates for L3 autonomous vehicle operating on expressways. Now, to put it in perspective, L3 technology, it's when the technology of the vehicle becomes significantly more autonomous. So at this point, maybe you can have a car that can really perform all driving tasks. It's a point maybe where humans can start to recline a little bit in their seats and focus on other tasks. That's what the technology is capable of, a step below what you see robotaxis operating at today, which is L4, but definitely above L2 that we see in terms of basic adaptive cruise control, lane centering, other sorts of technologies as well, Dave.
You know, Belle, when you mentioned L2, and I think a lot of people will appreciate this jump in my head. L2, L3, L4 just makes me think about my discs in my lower back, right? So L4, L5, a lot of people have herniations. And I'll just borrow, of course, people like me, we do need, of course, reclining seats when you do have bad backs, right? Because that alleviates some of the pressure on your L4, L5, sometimes even S1. Okay, anyway, how did I get myself into this corner? Let me pull myself out of this hole and then pivot back, get back on the road, talk about CATL, the world's biggest EV maker. We have a fantastic big take today on this. So get this, the company has powered 1 in 3 cars sold this year. That's according to data from South Korean-based NSE Research. But as growth slows domestically, the company is now looking abroad for expansion. Let's bring in our transport reporter here, Linda Liu, to talk us through today's big take. Let's talk about, pun intended, the road ahead and the road overseas here for the company before we talk about the challenges.
Yeah, so CATL is making a really big push into Europe. It's already built 2 factories, one in Germany, one in Hungary, where it's producing batteries to supply to its clients like Volkswagen, BMW, and Mercedes on the continent. It's building a 3rd factory in partnership with Stellantis in Spain. So it's really ramping up presence in Europe.
What's in the way?
In the way is a uneven EV demand. You're seeing that in China. You're also seeing a little bit of that in Europe. We just saw the EU essentially kind of scale back their commitments to phasing out sales of petrol and diesel cars by in the near future. So that step back, combined with some of European countries like Germany and France scaling back incentives to support EV purchases, could in the long run kind of slow down this demand for EVs. But I think CATL is banking that the transition towards EVs might be uneven, but it's not going away. So it's really putting its production capacity on the line there.
What can it do in terms of containing costs as it looks to expand then, if it really doesn't have any other choice but continue to look to Europe, really?
Yes, that's right. Europe is a really important market for car sales as well as EVs. Outside of China, you're probably seeing the biggest source of demand from the European continent. And another big factor is the higher prices that EV makers can command in Europe. So that's really going to help boost the margins of these manufacturers, especially considering at home there's a price war that's being waged for the Chinese companies. So CATL is also hoping to capitalize on some of those higher margins in Europe. But on the flip side, its factories that's operating in Germany and maybe possibly Hungary is actually at a lower efficiency and probably at a higher cost compared to its factories at home in China. So it's got a kind of a balancing act that it needs to address as it develops in the European market.
Not so much a focus, I guess, for this piece, but just generally, can you help us understand as well for next year for CATL the importance of energy storage systems as well to the business, given you've got maybe some weaker or more mature demand already for the EV battery side?
Yes, energy storage systems is actually a market that a lot of people are banking on for fast growth, especially now as the demand for AI and AI data centers are surging. So having these storage systems, I think, at these data centers will really help manage the energy demands that these operations will have. So CATL has already made a lot of groundwork and foundations for producing energy storage systems, not only in China, but in the US. It's actually very interesting. They are pivoting together with Ford to go into this energy storage systems market, with Ford hoping to leverage the licensing deal it has with CATL to start providing this type of products. That's actually an area that you have EV makers like Tesla already very strong in the space. So it'll be really interesting to see how CATL can kind of gain a little bit of access into the US market through partnerships like this.
Linda, great reporting. That was Bloomberg's Linda Liu there in Hong Kong talking about today's big take, which is China's battery giant needing new markets after dominating at home. And on that point, and continuing CATL, we actually spoke to them earlier this year, and the company told us that it's making overseas expansions its top priority, in line with what Linda was saying, but amid intense domestic competition. Its chief manufacturing officer spoke with Stephen Engel, our chief North Asia correspondent, at the World Economic Forum in Tianjin early this year.
Irrational competition, I will call. Everyone, the industry-wide and the government knew this is a problem, this is unhealthy, this will destroy the industry. So there's a lot of a sentiment to come up with regulations and policy to prohibit this kind of price war. Mm-hmm. And as a result, that also forced everybody to dig in. Can you further improve your internal efficiency and so maintain reasonable business margin to survive, to continue innovate? So as for that part, I expect they will.
How are you doing that? How are you improving your efficiencies?
We are trying to do everything, improve the production utilization.
How is AI employed?
AI has been used. Actually, CATL has been embracing the AI revolution maybe 7-8 years ago. At that time, it already started from simple, repetitive task and manual work. They try to use AI to capture, to do more efficient work. And now we not only using AI to screen the material, because of different material, different chemistry, and also different design. And also during the stage of manufacturing, and also after the sales. So AI has been utilized to improve, make sure the process is stable, is under control.
Over the next 5 to 10 years, what would your ideal next generation super battery factory look like?
Well, I would say in the next 5 years, ideally, let's take on all the trade barrier, all the consideration. Ideally, it should be green, number one, because we want to save our planet. The factory, we actually already do extensive improvement. We reduce our energy consumption, reduce any of the emission, and recirculate any of the waste material will be recirculated into our production. That is the number one. Number two, it should be smart so that any human labor-intensive, dangerous task should be taken care by machines, by robots, by computers. So that's what we are saying. Also should be reconfigurable, because when you put that production, this is a capital-intensive facility. Yeah. When you put that production line, you don't want to see, after a year, the end product, our customers' vehicle don't sell well. They say, we would like to switch that to a different vehicle. Right. Can you quickly, flexibly adjust, adapt to the new product? So that's our effort. We try to make it as user-friendly as possible.
How do you avoid the pitfalls of overcapacity that has affected the solar industry right now? Mm-hmm. And a lot of people in the industry are fearing that maybe there's going to be a battery overcapacity in the coming years. How do you feel about that?
Well, we don't look at that. We believe when the global community going to green, sustainable world, and there's a surge, the demand is drastically increasing. The key is a high-quality battery. Of course, you can. If you don't put a high standard, you can put a cheap battery. That capacity maybe is plentiful, but the consumer and our basically world-class OEMs in car industry, in energy company, they demand a high-quality, safe, and a long-life battery. For that, there's a shortage. Otherwise, we will not go to many parts of the world to make those high-quality batteries.
Would you say going overseas now because of the high demand? That's well, right. There's obviously, I wouldn't say the market is saturated in China yet, but there's a price war, obviously, which is brutal. Mm-hmm. Would you say, though, that your number one priority is kind of figuring out the international expansion? That's right. The best, I guess, algorithm for making it work. Mm-hmm. Is that your number one priority?
Yes.
And that was Ni Jun there, the chief manufacturing officer at the company exclusively with her colleague Stephen Engel. That conversation was back a few months back. Now, safety has really been staying largely on theme here. It really has been a major concern for the EV industry this year following a fatal crash of a Xiaomi car that then led to a nationwide uproar. Steve also had a look at the story. He took to a test track in Shanghai where CATL is looking to make charging faster and also safer.
CATL likes to think of itself as doing sort of the dirty work of building electric vehicles, not only where the rubber meets the road, but where the charge is put into the chassis. CATL's so-called skateboards are a modular cell-to-chassis product that integrate the battery cells under the floorboards with the chassis, engine, drivetrain, and other modules. CATL's many car brand customers then build out their own flashy bodies on top. And this stripped down and top off skateboard skeleton is not just for show. It rips on the test track. Our test drive took place just as CATL touted it can now offer 520 kilometers or 323 miles of range from an industry best just 5 minutes of charging time.
Total game changer, because with that technology and then the infrastructure that follows behind it, range anxiety should be a thing of the past.
CATL has more than 1/3 of the world's EV battery manufacturing capacity. They can scale it.
Analysts say this will be the year in China when EVs finally outsell internal combustion engine passenger cars for the first time. But tragedy also has recently accompanied that rapid growth. In late March, a Xiaomi SU7 traveling at high speed on an expressway with self-driving reportedly switched on plowed into a concrete wall and caught fire, killing 3 people. The Xiaomi accident really put the focus on EV safety, not only with autonomous driving, but with battery safety. This is the CATL first generation of the skateboard chassis. Underneath are the batteries. The next generation, called the Bedrock, is promising at least 120 kilometers an hour frontal impact will not cause a fire or explosion, also known as thermal runaway.
Greater oversight, safety will become a priority for a lot of these companies. They're all talking about it here. I think the problem with the way the self-driving technology features have been sold is it's caused people to think that they could be less attentive to the way the car is actually performing. You still need to monitor the car.
Putting the onus on battery makers, too, to make sure such a high-impact thermal event won't lead to a fire. For one, it's championing advancements in less combustible sodium-ion batteries, which CATL says are ready for commercialization. While this reporter is ready for perhaps just one more spin around the track. Stephen Engel, Bloomberg News, China.
And we're going to continue the discussion, on China's EV sector in the next hour. We'll have EV battery analyst Yun Mei from Great Wall Securities, and also the Automobility founder and CEO Bill Russo, who you just saw in that tape, but Bill Russo joining us as well. You can catch that interview at the Times on your screen. This is Bloomberg.
Right, welcome back. Just before we wrap up the show today, just a glance at markets in Vietnam. Some weakness today. We were up as much as 1%, if not more, in the opening minutes, have since clearly pared back. It's still one of the best performers. In fact, I'll say it's the best performing index over the past 5 days on political clarity is what we're pointing to at this point in time. On the up still, we're looking at gold. Of course, that's really been a big story. Gold stocks, specifically when you look at Indonesia, there we go on your screen, some of the big mining related names as gold continues to hit new highs. And just before we wrap up, a quick glance at the Hang Seng Index and also some benchmarks too. It's a reminder that we are a day to Christmas, and we have some early closures of these markets in Hong Kong, Singapore, Australia, and also in New Zealand, which is already shut. So truncated sessions there. And since this is our final full broadcast of the year, let me just take the opportunity to wish you all well, a happy holiday. Thank you for joining us, not just today, but for this year so far. We will see you all in full in the new year. For the economy, spend a bit of money. For your future self, maybe don't spend everything, but of course spend a lot of time if you can with your loved ones. From us here at The China Show, we wish you all well. We'll see you all in the new year. Thank you for joining us. This is The China Show.